Just to test,
afternoon.
Amanda, do we have audio? Or not, excuse me, Miranda.
Did you want to wait a few more minutes to see if we have any one else coming in, or do you want to go ahead and get started?
Whatever you think would be best.
Okay.
I'm fine with waiting if you'd prefer. So.
Okay, yeah, we'll just wait a few more minutes just to see if we have any last minute members coming. This is being recorded, just so everyone knows, so we can have these presentations available on our website for those who weren't able to attend. All questions can be entered in through the chat, so we'll try to answer those towards the end or as we are going along.
Miranda, would you like to, should we go ahead with the meeting?
Yeah, let's go ahead.
Okay. Well, first of all, just want to confirm, is everyone seeing a screen that says health insurance plan options? And of course, I'm asking that and your audio is muted. I trust it will. Miranda, if not, you can let me know. Well, I am Al Berg. I am with a firm called Northwest Partners, and we consult with the Williston Basin School District on their benefits. And the health insurance is our subject today. This year was one of those renewals I enjoy delivering for groups because for most of you, there will be no change in the premium. The coverage is going to be remaining the same. For the most part, there is one plan that will have a slight adjustment due to government rules, but otherwise you're going to be seeing plans that will be the same as what you've had. And what we want to do today is really dive into them a bit more because you have two plan options. There's a traditional plan with deductibles and co-insurance and co-pays. And then there is a high deductible plan with a health savings account or an HSA. And the feeling was after last year that there may have been not as much communication on that as we would have liked to have seen. No fault on the part of the district at all. But that's where we want to be able to go into that a little more depth today, as well as answer really any questions that you might have in regard to the health insurance. Just some general notes, though, as far as the upcoming enrollment, and you'll see more information coming out on this. But the enrollment for the district will be conducted next week and the week after, the weeks of the 24th and the 31st. Enrollers will be at site or on site throughout the district, and you'll be able to ask questions at that time, make any changes at that time, should you want to. The meetings this year, unlike last year, are optional. So if your elections are remaining the same, in other words, you want to keep what you got, you're not making any changes at all, you do not need to sign a new form. Now, the exception to that is if you are participating in the medical or the daycare flex plans. Those do not carry over. So if you are in either one of those accounts and you want to use them again for next year, you will need to complete a new form and elect your amount for 2023, even if you're not making any changes. And the reason for that is because if you sign up for a flex plan, if you've been in them before, the thing is that once you start, you can't change it during the year unless you have what's called a qualified event in order to change it. So that's why we make sure everybody, if you want to participate in that account, you do have to do a new election. However, if you're going to keep your health the same, dental, vision, any of the other insurance benefits, even your health savings account, even your HSA, you do not need to complete a form. Those who would look at a new form will be those that do want to make some changes for next year. Maybe you want to look at a different health plan, either get on the dental or get off the dental, sign up for the vision plan, any of those types of things. That's where you would see an enroller. And as last year, there will be representatives with AFLAC who will be doing the enrollment for all of the benefits. I'll also mention that I will be available as well next Wednesday and Thursday, and Miranda will be sending more information out as well. So I'll be, I believe, Miranda, correct me if I'm wrong, I'll be at the high school on Wednesday afternoon, and then at the middle school and attached buildings on Thursday morning. So if you have a specific question, because we obviously don't want to get into personal details during this meeting, but if you have a specific question about the health plan, or any of the other benefits, I will be available on site to be able to meet with you. And if you want to bring your spouse along with, if that works out, but glad to visit with you about those questions. And Miranda will send out some more information as far as scheduling for that. Let's take a look, first of all, at health premiums. As I mentioned, no change in premiums on one of the plans. Those of you who are enrolled in Blue Access, which is nearly about 3/4 of the employees are in Blue Access, those rates are going to remain the same for 2023. These are the monthly premiums that you see on the screen there. And then on the right-hand side is the Blue Sabre 3000 HSA. A couple of changes there. Those of you who are on the HSA plan, you think, well, I thought we had a $2,800 deductible. Well, you do for this year. Next year, due to a change by the IRS, the deductibles for a qualified plan will now go up to $3,000. So that'll be a slight change. Your deductible will go up by a couple $100 for next year. And then you'll see the premiums. Blue Access, as I mentioned, unchanged. The HSA plan, and this was just kind of an across-the-board change that Blue Cross Blue Shield of North Dakota did with all groups, and that is going up about 6.5%. So you'll see there's a bit of a narrowing in the difference in premiums between the two plans. Also, I wanted to mention the HSA contributions because I'll be bringing this into the conversation later as we go through it. The district does contribute into the health savings account for those of you who are enrolled in the Blue Sabre plan. And you'll see the amounts there. If you take single coverage, $83 a month plus change goes in. That's $1,000 per year that's contributed. If you have parent and children coverage or parent and child coverage, or if it's employee and spouse, then $125 a month or $1,500 for the year. And then if you have full family coverage, and that would be mom, dad, and children, $166.66 per month, which is $2,000 for the year. And I'm going to show some examples here in a few minutes of where those contributions would come into play. And this is an important thing because it can really make a difference as to whether or not you would take a look at the HSA plan and if that plan would be a fit for you and your family. Let's do a quick review of the coverage between the two plans as we review this. And by the way, there will be, or this is being recorded, so you'll be able to access it later. Miranda, I believe you'll be sending out the link or at least posting it somewhere. So if you want to take a look at it again, rather than having to furiously write notes, or if you would like your spouse to take a look at it, it will be available. So comparing the two plans, the Blue Access, again, as I mentioned, is more of the traditional plan, and you'll see that the deductible, there's two categories for that. If you have individual coverage, just covering yourself, a $500 annual deductible. And again, without making assumptions here, deductible, just to clarify on that, is the part that you pay toward the medical expenses before your insurance pays. Now, there are services on the plan, and we'll touch on that in a couple of slides, that where the deductible applies. There are other services where the deductible does not apply. Let's say, for example, you're hospitalized and you have surgery and they're brought to you by ambulance. You have scans and tests. All those types of services, the deductible applies. So you would be responsible for any one individual for the first $500 of the cost during the calendar year. And then you'll see it's $1,500 as you move up to the other levels of coverage. Of course, if it's a parent and one child, then it would just be $1,000 there. So it's a maximum of $500 for any one individual. And then family is $1,500. And then continuing on with Blue Access, you'll notice the next line, which is really the one I tell people to focus on even more so, and that is your out-of-pocket maximum. A lot of times we tend to look at the $500 deductible, and especially when you compare that to the HSA plan with the $3,000, that seems like a big differential. However, when you add in the out-of-pocket maximum, which is the total amount that you could pay, then you'll see that the differences narrow quite a bit, and I'll just let you read those on the screen there. But the out-of-pocket maximum would be your deductible plus any co-pays that you pay for office visits. There's co-insurance, which is 20%, and that 20% amount is once you reach the deductible, then you have a cost share between you and the health insurance plan, and you would pay 20%. The insurance plan would pay 80%. If you've heard the term before, 80-20, that's where that comes from. So you'd be responsible for 20% after you reach the deductible. The out-of-pocket maximum amounts listed there, and let's just use the individual as an example, that would be the total amount that you would pay for covered charges during the year. So that would include the $500 deductible. It would include the 20% co-insurance should you get into that territory, and it would include any of the co-pays that are on the plan, like for office visits or for prescription drugs. Once you hit $2,700 in covered charges for any one individual on the plan, and that would apply also if you have family coverage, any family member, the maximum for any one individual is $2,700. When you look at the Blue Saver plan, as we said, the deductible is quite a bit higher, but once you hit that, then you've maxed out for the year. So the co-insurance at that point is 0% on your end, 100% or 100% on the Blue Cross end of it. So the deductible is also your maximum for the year, and you can see that those two numbers are fairly close. And we're going to look at some examples to see how that would play out during the year. Adding to this, as far as the specific coverage, under the Blue Access plan, if you go in for a doctor visit, your office visit copay is $30. There is a telemedicine copay, and there you'll be getting more information that is going to be sent out from HR in the days to come. And on that, you will have opportunity to use telemedicine for things that can be handled over the phone or even virtually. Now, obviously, you're not going to get surgery done over the phone, at least I certainly hope not. But let's say as a condition that you know what it is, the person in the family knows what it is, and you're just looking at it, especially if it's a weekend or an evening, and you got to go to the ER. Well, what if it's, say, like an ear infection, and one of the kids have gone through this before and you know the routine and what the cost of the medication is, you can call in on telemedicine. You will talk to a licensed physician, and they are then able to actually issue a prescription for that medication, send that to the pharmacy of your choice. And that would apply to other things, let's say like pink eye or a sinus infection. I know my wife has had that quite often, and that's where we've used telemedicine. Again, for those things that you pretty much know where it is, but you need to have a doctor write the prescription. So that there will be more information coming on Amwell, but that can be a way to reduce your costs. And I need to correct this slide here, but that telemedicine benefit actually applies to both plans because it's not a copay, it's actually the cost for the service, which is $64 for that. And there's other services other than a general consult, which will be included. Okay, continuing on under the Blue Access plan, the emergency room, the facility fee, that's the actual charge for the room, $60 copay, and then you would pay 20% on the remaining charge. And then for the doctor, the provider fee is, that goes toward the deductible. And then if you reached your deductible, then you would pay 20% of that cost. Hospital surgery, ambulance, diagnostic tests, radiation and chemo, all those types of things, those are all services where you would pay the allowed charge, goes toward the deductible, goes toward co-insurance, which all then goes toward your out-of-pocket maximum. So that's how Blue Access works. Now, if you are on the Blue Sabre plan, how does that work? Well, that's the difference between these two plans, is that it's a different way of paying for it. You still have the coverage. The contracts, as far as what they cover, are the same. How they pay and how it all works together, that's where the difference is. And typically, we'll see probably more people sign up at the HSA plan than what we've seen with the district. And that's one of the reasons we're doing the meetings, is to explain the whole idea behind the HSA. And you'll be able to take a look at it as to how it might work in your situation. But if you go with the HSA plan with Blue Sabre, the big difference is that there's no copays. You're going to pay the full cost of those services, and we'll have some examples here in a couple of minutes, but you're going to pay the full cost of those services, and then you're going to have money going into your HSA account, which you can then draw from that HSA to pay those bills if and when they happen. And so when you go to the doc, and let's say that office visit charge is $150, and then you need to get a prescription filled, and that's $50. You're going to pay that full $200 under the Blue Sabre plan because everything goes toward the deductible. A couple of exceptions to that, which we'll touch on here. Okay, prescription drugs under the Blue Access plan depends on where that drug falls on the list. Formulary, and that's an important thing to remember. And by the way, when you go into the pharmacist, they'll put your information into the system and they'll do all the calculations for you. They'll be able to figure that out. There is a list available online. You can just do a search for the Blue Cross Blue Shield of North Dakota drug formulary list. The formulary is the approved list of medications that are under the Blue Cross Blue Shield of North Dakota plan. Non-formulary means it's not on the list. That doesn't mean it's not covered, but you would have more out-of-pocket cost with that. If it's a generic formulary, then you have a $7.50 copay per prescription, plus you pay 12%. But you wonder, where did that number come from? Well, that goes back to the days when your plan, at least for one of the districts, was on with North Dakota PERS, and that's the number that they use. So you pay $7.50 plus 12%. Brand name formulary drug, it's a $25 copay, and then you also pay 25% of the remainder. If it's non-formulary, a $30 copay and then a 50% sanction. And what that sanction means is that you pay 50% of the cost, and that does not go toward the out-of-pocket maximum numbers that we see up above. So you could have those non-formulary drugs, and you could run up, if you have a situation where it's a very specific medication and you have that sanction, that can go beyond the $5,900, or for an individual, go beyond the $2,700. Just want you to be aware of that. Now, again, with the prescription drugs, for at least for the formulary drugs, same as it was for the other procedures, those costs also go toward your deductible. So no copays, no co-insurance involved with that until you reach 100%, or if you do reach 100% of your out-of-pocket maximum. And again, that's where you'd use your funds in the HSA account. Non-formulary, the sanction would apply there just like it does under Blue Access. Now, an added benefit that the HSA plan has, the Blue Saver has, and this has been really popular because I've seen some of these medications that can run quite expensive, and it's a preventive drug. And if you get a preventive medication and you're on Blue Access, that's going to be covered just like is listed above, either as a generic or a brand name. However, if it's on the approved list, and again, we'll be getting that list out so that you can take a look at that, but that's a $5 copay for those. And there's medications on there, let's say for asthma, for diabetes, high blood pressure. There's other approved medications that are on there just for a $5 copay. And insurance companies came up with this idea because what they found when they put that higher deductible plan in on the HSA is that sometimes people didn't go in to get that prescription filled because they either didn't have money in their HSA or forgot how it worked or didn't want to spend the money or whatever it may be. And if they had to pay the full cost for that medication, they just said, well, I'll go without, or I'll cut pills in half or do that. And then what happened is that that condition that was under control with that medication got out of control. And then the medical bills in the long run ended up being more than the actual cost of the prescription because they ended up with a hospitalization, or they ended up things getting out of balance or out of whack again, and then they had to do some further doctoring. So the idea came up with, let's make these list of medications affordable so people will go get them. And you'll find when you see the list and that's distributed, it'll be a $5 copay. And again, I hear these comments over the years from people who are just amazed at some of the drugs that are on there, and now their cost actually will drop down to the $5 copay. All right, I want to spend the next few minutes talking about the health savings account, the HSA, and how that works. And the concept behind it with that $3,000 deductible is that you would use your health insurance to cover the larger expenses. Anything above $3,000, that's where the health insurance kicks in. Below that, you do get the reduced fee that the insurance company, that Blue Cross in this case, has negotiated on your behalf. But then you would use premium savings, but then you also use the contribution by the school district to help pay for those smaller expenses. And instead of paying the insurance company to pay for those small and medium size expenses, you use your premium savings, you use the contribution from the district to fund your health savings account. And then if and when those expenses happen, then you would pay those yourself. So the idea essentially is, instead of paying the insurance company to pay for it, you pay yourself, and then you pay those bills when they occur. And when we look at some examples, I think you'll see how that works. So let's take a look at an HSA in action. And one thing about the HSA, it's not just limited to medical expenses for you or for your covered family members. It does a lot more than just the medical bills. So on this plan with Blue Saver, you have a $3,000 annual out-of-pocket maximum, and that follows the calendar year, January through December. So who pays the covered medical expenses? As I mentioned previously, put the line at $3,000. Anything up to $3,000, you as the member pay. Anything above $3,000, that's the insurance company responsibility, provided, of course, that it's covered under the contract, which, again, the contract is the same as it is on the Blue Access plan as far as what's covered with that. And then the employer deposits funds into the employee's HSA account. You may remember we talked about that a couple of minutes ago. I'll show that again. You as the employee can also contribute to that account tax-free. You could take the premium savings. Now, the thing is, with the rate change this year, there's not as much premium savings as what we have seen historically, but there is some. So you'd have those savings that you could contribute. Plus, you can put your own money into it. If you've put money into a flex plan before, you could redirect that from the flex plan and put it into the HSA account. And there are some advantages to doing that. But again, the dollars go in there tax-free, both what you contribute and also what the employer contributes. You can then use those funds in the HSA to pay for medical expenses not paid for by the health insurance. Plus, you can also use them for other expenses, both now and in the future. So it's not limited to medical. You can also use it for dental. Let's say for braces for the kids, you can put it in there. Yeah, you still got to pay for it, but you're going to get the tax savings on it. And for a North Dakota resident, you're looking at saving about 20% of the cost. So you can use it for dental, for vision expenses, for glasses, maybe somebody gets LASIK surgery, any of those types of things, you can use it for that. And hearing expenses, hearing aids, for example, if somebody should need those, you can put money into your health savings account and use it for those expenses. By the way, I'll mention, and Miranda, you maybe did already, but just again, if you have a question, you can certainly put something into the chat box. Miranda, if you think it's appropriate to stop at any point and answer that question, glad to do so, or we can wait till the end and have a Q&A, and we can open up the mics at that time too, or you can just put it in the chat box. Here's the other thing about the HSA that I really like about it. It's not just limited to you. You can also use the funds in that account to pay for your family medical, dental, vision, and hearing expenses, even if that family member or family members are not covered by your insurance plan. They could be covered under a spouse's plan or covered elsewhere. You can still use money in that HSA account to pay their expenses. And remember, the school district is contributing anywhere from $1,000 to $2,000 every year into your HSA, depending on your level of coverage. And that money now, rather than in the past where it would have gone to premium, now goes into that HSA, and it gives you a lot more places where you can use it. And think of it of places where you may have expenses and they may not be in the medical realm. So again, one thing I like about this, it gives you a lot more flexibility. Also, you can accumulate funds in that account for future expenses. Because you have it in there doesn't necessarily mean you need to pay that bill right away. For example, we have somebody in our office that they have a kind of a family rule that any bill in their when they work in their budgeting, their idea is that any bill below $100, they pay that out of pocket rather than out of the HSA. And then they just let the money accumulate in the HSA in the event they have a larger expense down the road. $100, that was their arbitrary budget number. Again, it's entirely up to you as to how you want to manage the funds in there, but that is one way of doing it. In fact, I know some people, they just pay all their bills out of pocket, and they use that HSA account to build up, because not only can you accumulate for expenses maybe later in the year or even in the next year or two, you can also let that money stay in there, and you can build toward retirement with that HSA account. So a lot of flexibility, and that's a big difference with the HSA compared to the flexible spending account. Those of you who've used Flex before, you know you have the famous use it or lose it rule. Every year, with the exception of a small amount that you can roll over, you need to use the funds in there, and what you don't use, you lose, with the exception of that rollover. With the HSA, once the money's in that account, it belongs to you. It is your money. You can reimburse yourself for expenses. You can pay bills out of that HSA, or you can let it accumulate over time and have it as a retirement account to pay medical expenses at the time of retirement. Or you can even use it to take a trip or go on a cruise or whatever it may be. It's money there, just like it would be if you put money into a 403B or into a retirement account. So a lot of flexibility with that HSA. Both plans have preventive coverage and benefits. Those are mandated and required under the Affordable Care Act. And these have been nice benefits. People have appreciated having these. So things such as annual physical exams, cancer screening tests, immunizations, smoking cessation programs, contraceptives, all of those covered in full at 100%. No deductible, no copay, no coinsurance. You just give them your card and those are covered. There will be a list available as far as the covered services for that as well. I mentioned some examples, so let's take a look at how these two plans would pay, and that can maybe help you in deciding which one is going to be the best fit for you. So you'll see the two columns there, Blue Access and Blue Saver HSA. Let's say you go in for an office visit and then a prescription with that, and the total cost is $200. Under the Blue Access plan, your cost would be $42.60. That's after applying copays and coinsurance. Under Blue Saver, it's $200 because everything, as we mentioned, goes toward that $3,000 deductible. So your cost differential there, as far as what you would pay out of your pocket, is $157.40 in that particular situation. In a moment, I'll bring in the HSA dollars and we'll see how that fits in. Let's look at another situation here. This is one where probably the biggest differential of the examples that we'll look at is that under Blue Access, let's say you have an outpatient procedure and the total bill on that is $6,000. Your cost after insurance under Blue Access is $1,600. That's the $500 deductible plus the 20% coinsurance. Under the Blue Saver plan, $3,000 because you pay that $3,000 deductible. So be aware of that. So the difference between those two is $1,400. Well, this is where, oops, hit the wrong one. Sorry. I hit my end button instead of the page down button. Now, what I calculated on the bottom here is the contribution made by the district plus the premium savings that you would gain, the difference between the two plans. So what this is assuming here is the $1,000, the $1,500, or the $2,000 that the school district would contribute into your HSA, and then the savings in premium that you would gain to be the difference between the two plans. And you'll see if you have single coverage, $1,072 that you would have in the HSA for the year. This does not include any additional contributions that you would put in. Parent and children, $1,626, two-person, $1,687. The difference there is just simply the difference in premium for those that are the two adults that are covered under the plan. And then if you have family coverage, $2,187 you would have available in your HSA. And as you can see, the cost differentials there, that's where you could draw on those funds to pay for those bills. And the reality is that for a lot of people, they don't have a lot of expenses during the year. Some of you obviously do. But as I look at the statistics for health insurance plans, there's a good share of the people that are covered by the health insurance that really don't need to do a lot of doctoring in any given year. And so with this idea is if you put that money in, and most of this, of course, is contributed by the school district, is that those dollars, if you don't need them for medical or you don't need all of them for medical, you can leave it there. Or you can use it for other expenses for yourself or your family. So again, it gives you a lot of flexibility. So in looking at these plans, it's really kind of a matter of determining which one do you feel most comfortable with, how much are you willing to take a risk, and the risks on here aren't that significant in most cases. Yes, on the outpatient procedure, yeah, but on the other ones, which we'll move to now, the differential is not that large. Let's say you had a surgery and a hospitalization and the cost ended up being $50,000. The cost after insurance, again, is going to be the out-of-pocket maximum on both plans, either $2,700 or $3,000. So you're looking at a $300 differential. But again, keep in mind that you've got those funds in the HSA. And that's a lot of times people overlook that because they tend to think high deductible. Boy, I could have big expenses out of pocket. Well, with the HSA contributions in there, that really narrows the gap. Another one I make people aware of, because this could be a situation you face. Let's say you have a high cost medication. And just for example purposes, let's say that's $800 a month would be, and that's before any copays, anything like that. Let's say that's what the cost of that script is. Your cost per month under Blue Access after applying the deductible and coinsurance comes out to $218.75, and that expense you're going to have that every month. So if you stretch that out over 12 months, that's $2,625 that you would spend for that medication. Under the Blue Saver plan, you pay the full $800, and you're going to continue to pay that until you hit your out-of-pocket maximum. But here's the difference here is that once you hit that $3,000, then you're maxed for the year, and then any scripts after that, which is roughly after 4 months, then it's covered 100%. And that, again, that's not per prescription, that's for you. And that applies to everything, even if you end up having surgery, doctor visits, or whatever. It's a total of $3,000. Insurance takes over after that. So a lot of people in meetings say, well, I'm on my husband's plan, and once I went in for a prescription and I had to pay this out of pocket, and then the next month I went in and I didn't. Is that what happened? And I said, exactly. You hit your $3,000 deductible for the year and you maxed out. And after that, the expense on those covered medications is covered 100% by the health insurance plan, provided, of course, it's not a non-formulary medication. So again, you'll need to look at your individual situation, and that's why I'll be glad to be available next week when I'm in Williston. I can sit down and meet with you, because I see this in every group I work with, especially with school groups. People will say, here's a situation I'm dealing with. I'm looking at, should I be on my spouse's plan? Should I just be on my plan? Which one should I go with? And we can talk through your situation. I can't, or I'm not going to be able to say, yes, that will be covered, no, that won't be covered. But a lot of times we can help you work through it as far as figuring that out. In fact, if you want to send me an email, you can even do that, and Miranda would have my email address, and if you want to send that in advance, I'd be glad to take a look at it and we can go from there. Okay, some rules you need to know about the health savings account. First of all, in order to have the HSA, you have to be enrolled, you must be enrolled in a qualified high deductible health plan in order to fund the HSA. That means you would need to be enrolled in the Blue Saver 3000. If you are in the Blue Access plan and want to have the separate account, that would be the flexible spending account. If you're on Blue Access, you cannot have an HSA plan as well. You own the account, as I had mentioned before. Once those funds go in and they're deposited either by you or your employer, those belong to you. The employer does not and cannot track that account. It's really like them doing a direct deposit into a checking account, because really your HSA account functions very much like your own personal checking account, and then you can pay bills out of that. If you leave employment, whether by retirement or you change jobs, those funds belong to you. You can take them along with you. You don't forfeit them. They are yours, and you can use them in the future to pay any medical bills not covered by insurance. The deposits that go in are tax-free. You don't pay any income tax, or any Social Security tax on that. And that's also income tax and federal and state income tax. Now, that's provided as long as when you take that money out, you use that for qualified expenses. So the withdrawals are also tax-free, but they do have to be for qualified expenses. Non-qualified withdrawals are subject to taxes and penalties, very much just like as if you had your 403B, your retirement account, or a 401k. As I mentioned, HSA is similar to a checking account. Payments can be made with a debit card or with a funds transfer. Getting your money, here's another big difference between an HSA and a flex account, is that on the flex account, is that with the HSA, there's no filing of claims for approval to get your money. If you used flex before, you know you have to send it into the flex police to review your claim, and you have to attach either the bill or the why am I I'm drawing a blank on it. I know this term, I've used it thousands of times, I'm drawing a blank. Anyway, the statement that comes that says this is not a bill, and you have to send that in to prove your expense. With an HSA, not the case. It is on the honor system. You can just request the amount, or you use your debit card that you get, and that can pay the bill, or you can go online and reimburse yourself. You would only prove if your expenses are qualified if you're audited. So if you have an audit by the IRS, they look and see you contributed into that HSA, which there is reporting that goes on, so they will know that money did go into your HSA and money came out. They don't know what it's for, but you would need to show that you used it for qualified expenses. So no use it or lose it rule. What you don't use during 1 year, you can roll it over to the next year. You can change that contribution during the year. You know, with a flex account, once you set your amount for the year, that's what it is. Unless again you have a qualified event where you can change it. With an HSA, you can change it, you can raise it, you can lower it. I've had situations where people start out at a certain amount and then something comes up that they weren't planning on as far as an expense. Well, yes, you'll still have to pay for that expense, but you can put money into it. You can go to Miranda or whoever handles payroll, and you can say, could you take out this amount out of my next paycheck or next couple of paychecks? And they can do that. It goes into your account. So you're allowed to make changes during the year. Now, obviously, Miranda would appreciate it if you're not making changes every month. And I don't see that happen. But the big thing with an HSA is that you can change it. Here's another difference between the HSA and the Flex account is that in the HSA, there's no overdraft protection. You can only get out what you've put into it. Whereas with a Flex account, one of the nice things about Flex is that you make that election for the year. Let's say you set it at $2,000. That $2,000 is available to you in full day one of the new plan year. Some of you may have used that way before, where kids start with braces and you have to make a down payment, or somebody has LASIK surgery. Guess what? You can turn in a claim under Flex for that full amount, and you'll get paid that. And then for the rest of the year, you just pay on the installment plan where they continue to take deductions out of your check. And of course, the employer hopes that you don't quit and leave employment, because once you get that amount, they can't recapture it. An HSA, you get paid what goes in there. Now, if you don't have enough money in there to cover the full bill, once you do get more money in there, you can go back and reimburse yourself for that old expense. So you still get the tax savings on it. You just may not get it all at the time that you actually use it. And the HSA is going to be administered by a company and is administered by a company called Health Equity. What else to know about an HSA? You cannot contribute to an HSA if you are covered by a non-high deductible health plan. Again, if you're on the Blue Access plan, no go on the HSA. If you're on your spouse's health plan and it is not a qualified high deductible plan, for example, your spouse works for the state of North Dakota, they get full family coverage through North Dakota PERS, you're covered under that plan. Most likely, you probably wouldn't be enrolled on the health insurance with the school district anyway, but if you were, you would not be able to contribute to the HSA because you're on a non-qualified plan. If you're enrolled in Medicare, even if it's just Part A, that counts as a non-qualified plan. Enrolled in a medical flex plan, and this is where it gets a little tricky. So if you're coming to the point where you're doing the annual enrollment, one of the reasons we do this on January 1, is that if you're covered under a medical flex plan, even if it's under your spouse, you cannot, by the regulations, contribute to an HSA because a medical flex plan is considered to be a non-qualified health insurance plan. So if you enroll in the high deductible plan and you want to contribute to HSA, you can't do the FSA through the district. Plus, your spouse would not be able to do an FSA to their district if you wanted to contribute to the HSA. Again, if you have questions on that, I'll be available to visit on that in the future. How much can you put in? The IRS did a significant increase, at least relative to what they've done in the past. Typically, these have gone up by like $50 a year, or maybe $100 a year. This year, they boosted it by $200 and by $450. So if you have single health and coverage, you can deposit up to $3,850 into your account. And that's combined between what the district pays in and what you contribute. If you have dependent coverage, if you're covering any family members, then you can contribute up to $7,750 for the year. Again, you don't have to do that much. You can put in $10 a paycheck if you want to, entirely up to you. But that is the maximum amount that you can put in the account. And if you're 55 or older, or if you turned 55 during 2023, you can do what the IRS calls is a catch-up contribution, which is an additional $1,000 per year into that account. So you got family coverage, you can go up to $8,750 into your HSA. While there is an annual maximum, there's no lifetime maximum on an HSA. I know of people who have literally tens of thousands of dollars they've accumulated in their HSA over the years that they can use for medical related expenses or other things going into the future. So no limit on it lifetime. And then when the account reaches a certain amount, you can invest with those funds. Now, of course, the last year wasn't the best year to do that. You probably just want to keep it in the regular savings account rather than the investments, because most likely you're going to be losing money. But you do have that option to go into investment accounts with the plan. And then one last thing we'll talk about is distribution rules. What happens when I retire? More specifically, let's talk about what happens at age 65. Those funds can then be withdrawn without penalty, the same as if you had a 403B or if you had a 401k. The magic age is different. Of course, with the 403B, 59 and a half is the age where you can take money out without penalty. With an HSA, it's age 65. You can take it out without penalty. However, well, I can say, and actually the good thing about it is that if you use it for medical expenses, even there, it's not even subject to taxes. So that's the best way to use it, is the savings you build is to be able to use it for those medically related expenses. If you use it for non-medical and you've built up a substantial amount there, you don't think you'll use it all up, then it's just treated just as if it was a withdrawal out of your retirement account, and those distributions are taxable. You can also reimburse yourself for expenses that occurred in prior years. I mentioned earlier that some people will let those funds build. They pay the bills off and they let the funds build. As long as you keep those receipts, got a record of them, you can go back later and reimburse yourself, and you can do that at any age. And again, if it's for medical bills, you don't pay any taxes on it. And you can also use those funds for certain Medicare premiums as well. Not all Medicare expenses, but you can use it for certain premiums within that, of course, along with any other medical related expenses. Okay, that's a mouthful there as far as that. Miranda, any questions at all that have come in regard to this?
Yes, I believe some of these were answered already, but we'll still go over them. Do unused funds in the HSA account that would roll over become taxable as income?
The answer to that would be no. They would only be taxable if you take them out for non-qualified expenses.
I have an HSA from a previous district. They opened an HSA in an online bank called Optum. Can I just continue using this HSA, or should I set up a new HSA?
Yes, you can do either one. I see it done both ways, where people keep the old account. I would, and you can roll those funds over to the new account. I would recommend a new HSA through the school district. The reason being is that way, when they do payroll, they can do a payroll deduction from your check and then deposit the funds directly into that account, which is probably what you did with Optum. And that just makes it easier. And then it's entirely up to you whether you want to leave those funds with Optum or you can do a rollover. And these administrators for these accounts, they handle this on a regular basis. So they'll have forms available that you could fill out, and they'll actually, once you submit that, they'll just take care of getting those funds transferred over on your behalf.
And the last question we have, do you have to wait to retire before rolling the HSA into an IRA?
No, you can do that. There probably is, at least at this point, not any advantage in rolling it over to the IRA. And there are specific rules, which, to be honest, are not on the top of my head with that. but no, you could roll it over the IRA. I believe on that one. We'll need to do some checking on it. Even in the prior question where the person talked about with Optum, they could roll it over. I think it might be a little bit clunky in doing that, but to this question, no, you don't have to wait until 65 in order, or retirement, in order to roll it over into an IRA.
Those are the only questions we had in the chat. Are there any other questions anyone has? I did want to note on the premium shown that those were based on a 12-month deduction rate. If you are a classified employee that only works school schedule, you do have a 9-month deduction rate. So those premiums are a little bit higher since we don't deduct during the summer, but you're still covered. I just wanted to make a note of that.
And that would also apply with the HSA contributions from the district as well, too, right?
The HSAs are still processed monthly, even when they don't receive a paycheck.
Oh,
So
okay.
during the summer, yeah, because we just process those through Health Equity and then input it manually into our payroll system, so it evens out.
Okay,
So
that's good. Anything else, Miranda, that I may have missed at all, or questions you've thought of?
nope, I don't think so. I mean, I was writing stuff down, but then you would end up answering them, so.
I claim to have read your mind on that one, but
Yes, yes.
This presentation comes from years of doing these meetings and questions that come up during that. So I think we touched on what really is the thing that's going to apply for most people. And really, either plan can depend on it. You know, one thing I will mention on an HSA plan that sometimes people will look at it and say, no, I'm not going to do that, is the fact that you now have one more account to manage. And some people say, yeah, you know, I like that idea of having that HSA account, but now I got to keep track of that. Now, of course, the difference here is the fact that the district is going to put money into that account, which you wouldn't get otherwise. So that might be an incentive for some people, but it is something to consider that you do need to keep track of it. The good thing is that you don't have to go through the process of filing a claim for every expense. I just keep a file folder and I just drop my expenses, my explanation of benefits. That's the missing term that wasn't there before. The EOB, all those things. I just keep those in a file folder. And then when I do go online and reimburse those, if I haven't paid for them through the debit card, then I'll just indicate on there the date as to when I paid them. And then also online, a lot of the services have that too, where you can make a note on there too as to what you used it for. Okay, well, 7 minutes to go, and then we have another presentation on the dental and vision insurance plan, which I can guarantee won't be anywhere as long as this one was, but hopefully as exciting. So feel free to dial into that one if you prefer. We're just going to do that one once. If you enjoyed this and want to watch the rerun, we're on again at 4 o'clock on Monday, or tell your friends, tell your coworkers, let them know about it. And then, of course, this was recorded, so the link will be available for it as well. If not, Miranda, I'll leave it over to you to wrap things up.
Thank you, Al. Yeah, if anyone has any questions, please direct them to me via email, miranda.gumwilson@willistonschools.org. Or if it's easier to remember, just payroll@willistonschools.org. I'll get both of them. And thank you for attending.
Thanks, everyone.